Hi, I'm George Nordhaus, and welcome to Monday Morning. Mergers and acquisitions. It's about time we talked about something like this, isn't it? And who better to go to than Reagan Consulting? They've been friends of mine for many, many years and worked with Bobby Reagan, Shirley Lukens, and so forth. Well, they have a new young man whose name is Brian Deitz, and he's very interesting because of his background, and he is their mergers and acquisitions expert. There he is. Brian, tell us about yourself.
Sure. I think, Reagan's mergers and acquisitions expert might be a little strong, but I appreciate it.
That's all right. I want to help you out. Whatever.
No, that's great. I have been in mergers and acquisitions and valuation my whole career. Spent time in kind of the classic Wall Street investment banking job after college, and then did mergers and acquisitions and valuation for Home Depot in Atlanta for 4 or 5 years following that. Have been with Reagan in the insurance distribution industry for the last 7.5 years, and am glad to be here. It's interesting how the insurance industry never seems to be the initial destination, but often the arrival point for so many of us.
Well, that's a good thing that you have that. I think it's great that you have that experience outside of our industry, because most everybody's been in it. We get kind of prejudiced one way or the other, but you come from the outside, seeing what the real world really is, and then be able to translate that. So let's talk about it. What's going on?
Sure thing. Well, let's dive in here and just chat about mergers and acquisitions. But before we do, this is a topic that we get a lot of questions about at Reagan, and it's a topic that's very interesting to agency principals, even if you're not buying or selling an agency. And I liken it to real estate and being a homeowner. And if you own a home, whether or not you are wanting to buy or sell that home, you're very interested in what your neighbor's home just sold for. And you do all these mental comparisons about, well, gee, the Smith's house went for X dollars, and they've got a garage. We don't have a garage, but we've got one more bedroom. And so it's even if you're not considering selling your house, it's a really interesting dynamic to understand what that house might be worth. And the insurance agent and broker M&A market is very similar for agency principals. Agency principals have a lot of wealth invested in their agencies. And so when you start talking about what those agencies are worth and who the buyers are and what the prices and multiples are for certain agencies, it's really interesting whether or not you actually intend to buy or sell in the near future. And so let's chat about just what's going on in the M&A market, and we'll start with kind of just some quick slides on the numbers and then get into what's driving those. And the overall sentiment that we see is that the M&A market is very healthy. And if you look at the deals that have been announced over the last several years, it ranges from 190 to 327, but these are announced deals, and a lot of deals are getting done. 2010 to 2012 was probably the most acquisitive 3-year period in recent history. And even though deals dropped in 2013, they dropped because a couple of reasons. Neither of which is really anything fundamentally changing with regard to the M&A market. And one of those reasons is simply the tax law changes that went into effect January 1, 2013. Capital gains taxes increased for many sellers as of that date. And so folks that were thinking about, gosh, maybe I'll sell my agency, did it in 2012. And so a ton of deals were done in 2012, specifically late 2012. And you can see here 134 deals done in the fourth quarter, 39 deals done on December 31 alone. And those are just huge numbers and indicative of principals getting deals done in 2012 to take advantage of lower capital gains tax rates. And so that's one of the reasons that pulled down the total number of deals in 2013, because a lot of the deals that would have been 2013, especially early 2013, went in 2012. Mm-hmm. And so we don't see this, George, as a real momentum halting thing, that 2013 was a lower total. Because of that reason, and one other that we'll talk about in a second. But what gives us confidence in the ongoing health of the M&A market is certainly how 2013 finished. 28 deals in November, 30 in December. And you look at that, it's in stark contrast to kind of the 9 in March and 14 in April. And so after you kind of, the backlog was rebuilt after so many deals were accelerated into 2012, deal volume kind of picked up at a high to normal high pace in the latter half. Mm-hmm. And so the M&A market overall remains strong. A lot of deals getting done. We always like to look at who is buying, and these are the top 7 or 8 buyers in 2012 and in 2013, and these are kind of the usual suspects. If you're talking about who is purchasing insurance agencies, it's going to be these firms, and you can see here that these 8 firms accounted for 183 of the 327 deals in 2012, 102 of the 215 deals in 2013, and so 50 to 60% of annual deal volume, at least for announced transactions, is coming from these 8 large national brokers. And these folks are a mix of private equity-backed brokers and publicly traded brokers. The private equity folks are Hub, CompuSeguros, Assured Partners, Fidelity National Financial. Think of them as kind of a private equity-backed firm, and USI, and then Gallagher, Brown & Brown, and Marsh are publicly traded brokers. But these are the folks that are kind of on the list for many firms as they seek to find a partner for their agency. And a couple of things to point out here, and this is, I alluded earlier to another reason that total number of deals was down in 2013. If you look at the Gallagher line and the Brown & Brown line, Gallagher went from 60 to 15 and Brown & Brown from 16 to 5. Those 2 firms alone accounted for a lot of the decrease in deal activity in 2013 from 2012. But it isn't because of they have some sort of dimmed enthusiasm on acquiring agencies. It's simply because they acquired big firms in 2013. And when these buyers here think about acquisitions, they don't think about it in terms of number of deals. They think about it in terms of how much revenue am I going to acquire. Mm-hmm. And so if they can do that with a small number of larger deals, they will, and that's what happened to Gallagher and Brown & Brown in 2013. Gallagher acquired Bollinger, Brown & Brown acquired Beecher Carlson, and they've done some other large deals as well. And so these firms may have acquired the same or more in total revenue, but they did it with a smaller number of deals. And so we don't think that represents any kind of lack of eagerness to acquire, as much as it means that they just expended their agency on larger deals.
Got it.
Now, the other side of the equation, in terms of kind of the supply and demand in the M&A market, is valuations. And valuation in 2013 was pretty strong. And so we've put a chart here together that shows purchase price as a multiple of EBITDA for very high quality mid-sized agencies, and we've categorized that as 3 to 10 million in revenue.
Now, when you say revenue, excuse me just a second. I want to make it clear that revenues is income from all sources, right?
That's correct. It's commission and fee income and contingent income.
Okay.
Is what we're talking about.
All right.
in revenues.
Thank you.
Sure. You'll notice that these bars here have two pieces, a guaranteed price and an earn-out price, and that is because the vast majority of transactions in the insurance distribution space have a fixed price, a guaranteed price, and then another potential price paid based on performance post-close. And so what will happen is that, let's just use 6 times, for example. An agency will be paid 6 times EBITDA, earnings before interest, taxes, depreciation, and amortization, at closing. And then they'll have the opportunity to earn another 3 times EBITDA, let's say, based on their growth, either in EBITDA or in revenue after close. and it's a way to really align interest between seller and buyer, bridge valuation gaps, and allow for some of the risk transfer that happens in the deal. Sellers will say, hey, I think I should get 8 times, I should get 8 times EBITDA, 2.5 times revenue, whatever the numbers are. And a buyer will say, oh, okay, we can do that, but in order to do that, we need you to grow by 10% for 3 years or whatever the targets might be. And so an earn-out allows the seller to get to the eventual price that the seller wants, and allows the buyer to ensure that performance is met to meet that price.
Hey, excuse me, let me tell you something. I have a friend who, and this is all coming into clarity for me now. I have a friend who sold to Gallagher, and he had when he sold, he had about 2.7 million or something like that in revenues. He stayed there and everything else, and when he finally got out, 6 or 7 years later, they were at 7 million something. So he really must have made a ton on that extra deal, huh?
Well, gosh, that kind of revenue performance certainly sounds good for maximizing your earnout. But that's exactly right. And the situation you just described, George, is the perfect win-win deal scenario.
Right, everybody.
Because these buyers would like nothing more than to pay out the very top end of the earnout. They'd love nothing more than to give sellers every possible dime of purchase price, because it means, like your buddy, that they've grown exponentially during their period of early ownership by the buyer.
Right.
And so that's a great situation. In 2013, as you can see from this chart, valuations were very high, the highest in the last 7 years. Typical multiple 6.75 guaranteed with the opportunity to earn a little bit over 9. Those are very, very strong multiples. And we always have to caution when we show this chart that this isn't a cookie-cutter industry, and every agency is a little bit different, and there are a lot of reasons why an agency might trade for 6 instead of 6.75 or 7.5 instead of 6.75. So it's always a little bit difficult to just say, gosh, I'm worth 6.75 when there are some things that could push it more, or some things that could push it less, and all kinds of things are going to influence this multiple, like revenue growth and specialty business and concentration of revenue by carrier or client or producer. All kinds of things go into this number, but these are pretty typical numbers, and they've been very strong in 2013.
Well, Brian, I've always heard, I mean, all these years, everybody was, when you talk about selling your agency, say, well, I got 2 times for it, or I got 1.5 times. What they were really talking about, I guess, is revenues, 1.5 times gross revenues. Used to think that way, didn't they, instead of EBITDA?
That's right, and I think that the revenue multiple still kind of widely used to ballpark the deal. But the more accurate method of pricing is going to be EBITDA, because buyers can't fund acquisitions through revenue, but they can fund it through profit. And if a firm is making, let's say you've got 2 firms, George, one that's making a 10% margin and one that's making a 20% margin.
Mm-hmm.
If you paid 2 times revenue, you'd wind up paying 20 times EBITDA for that first firm and 10 times EBITDA for the second firm.
I got it.
And so what happens is people love to express the multiples and the valuations in a revenue multiple, which is fine. But when you're actually understanding what's driving the pricing, the EBITDA multiple is a much better indicator of value.
Got it.
And the windows are going to be much tighter on an EBITDA multiple than a revenue multiple.
Mm-hmm.
All right, so what I thought we'd do next is talk about the 4 or 5 things that are going on to drive the health of the M&A market. And as we've just seen, activity, though down from 2012, remains strong, and valuations are high. There's a lot of competition in the marketplace, and so why is that? And I thought we'd run through just a few slides to say why that is. And the first thing is just that brokers are performing pretty well, and that has driven valuation and also brought probably a few more sellers to the marketplace. This is a chart that shows organic growth rates and EBITDA margin for brokers over the last 6 years. And we do a study at the end of every quarter. It's a real-time study where we get organic growth and profitability results for usually about 135, 140 agents and brokers across the country. Median revenue about $15 million in annual commissions and fees.
Mm-hmm.
As you look at this chart, you can see some pretty neat trends in performance. Organic growth was negative in 2009. Now it's over 6 in each of the last 2 years.
Mm-hmm.
EBITDA margin up almost 300 basis points from 16.6 to 19.3 over the last 4 or 5 years. And so when you've got an environment where agencies are performing pretty well, it makes principals, I think, a little more comfortable with doing a deal, because, like your friend, they can be more confident in maximizing an earn-out. And in 2008, 2009, early 2010, if you see those numbers, low growth, declining profit margins, 2009, 2010 were slower years from an M&A perspective, because there was a lot of doubt about performance on both the seller side and the buyer side.
Mm-hmm.
As performance has improved in the insurance distribution industry, the appetite for M&A, both for buyers and sellers, has increased. So that's the first thing that's happened.
Mm-hmm.
The second thing that's going on is private equity capital has continued to invest very aggressively in agents and brokers. And we've got this bar chart here shows the percentage of deals that were done by buyer type 5 years ago in 2008, and then in 2012. We don't have 2013 completed yet. But if you look at the light blue bar that represents private equity did 14% of all the deals in 2008 and over 30% in 2012.
That's fascinating.
It is. It's very interesting. They've more than doubled their number of their kind of market share of acquisitions. They're the leading acquirer of insurance agents and brokers. I actually think if you looked at this chart for 2013, it might even be more skewed to private equity, doing greater than 30% of total number of deals. When you think about Gallagher, who's a publicly traded broker, did relatively few deals for them in 2013, and so private equity is doing a lot of deals, and that's happening because private equity firms have invested in and recapitalized too strong, but several of the large national brokers. Onyx is now the lead investor in USI. Hellman & Friedman is lead investor in Hub, et cetera, et cetera. And then you've got the smaller firms, such as Epic or Acrisure or Risk Strategies, that are also private equity backed, that aren't as large as the national players, but are still very aggressive in acquiring agencies. And so when you think about the number of private equity firms that are acquiring, it's increased fairly dramatically in recent years. And part of the private equity strategy is to invest and build the firm via acquisition and organic growth, and then to have a liquidity event, either go public or sell to another private equity firm in kind of 5 to 7 years. And so every time that a private equity firm invests in an agent or broker, you can be fairly certain that that's going to result in more acquisitions by that agent or broker. One of the things that fuels private equity interest is just that the fundamentals of insurance distribution are so strong. We've got a business that renews every year. Agents and brokers aren't starting from scratch. They've got a book that typically renews at 85 to 90%, even higher for certain firms, and that's very attractive. And it's also a business that generates a lot of cash flow. You were alluding to my background, George, in different industries earlier. One of the things that's really interesting about insurance distribution is you can generate really high margins, EBITDA margins of 20, 25, 30%, without investing a lot of capital in the business. You don't have to have a manufacturing facility or a big research and development cost or a warehouse full of inventory to do well in this business. And that's certainly one of the things that attracts private equity. The other thing, and this is can't underestimate this factor right now, is the cost of debt. Private equity likes to use debt to magnify the returns that they get on their investment. And so typically when they buy an agency, they will fund the acquisition of that agency with some cash equity and then through borrowings, debt. And then they will repay the borrowings over time, and the value of the firm will rise and go all to the equity holders. And that's kind of a financial model that private equity has used for a long, long time to really accelerate the returns on the equities that they invest. And the cheaper the debt, the easier it is for private equity to do that. And right now, as you are aware, interest rates are low and the cost of debt is low. And so this kind of debt fuel that private equity has is pretty cheap. And we think that is certainly fueling a lot of the acquisition activity by private equity firms.
Got it.
So this private equity thing is a big deal and is driving a lot of M&A. The other leading group of acquirers are the public brokers. And we've got a chart here that shows the valuations of the publicly traded brokers over the last 6 years as a multiple of their EBITDA. And as you can see, 2013, where the public brokers are trading on average at about 12 times EBITDA, that's a call it 25% valuation jump from where they've been over the last 5 years at year end. And this is significant for publicly traded brokers because it makes doing acquisitions for them a little bit easier. For example, if you knew that you were going to get rewarded by the public equity markets at 11 or 12 times EBITDA, well, it's a lot easier to pay 8 or 9 times EBITDA all in for a transaction at that point because you've still got some kind of quote-unquote arbitrage opportunity between the valuation that you're using to acquire and your valuation in the marketplace. And that gets harder when you're trading at 8.3 times, as the publicly traded brokers were in 2009. There's not as much room to get aggressive in price, and so this dynamic we think has helped to drive values upward in 2013, and assuming that there isn't a market correction, this will likely continue to fuel deal valuations in 2014.
Good.
So that's another thing that's going on. Two more things here just to chat about. Large deals, large values. There have been some really large transactions that have been done over the past, call it 18, 24 months. All of the deals, all 8 of them on this page are over $100 million in revenue, and that's a big deal. And the average EBITDA multiple for these is north of 10 times EBITDA. And so what's happening is that the competition for you know this, George, just by looking at the Business Insurance Top 100 list, there aren't that many agencies over $100 million in revenue.
Oh, very few.
And that's right. And so when one is available for sale,
the
competition for that is intense.
Ooh, I'll bet.
And that's right. And so we've seen that quite a bit over the last 24 months, and even in early 2014, Barney & Barney acquired by Marsh Agency. There's just a lot of aggressive appetite for these large deals, and because of the rarity of it and the competition for it, they're getting done at really large values. And so that has been really interesting to watch. The final thing to talk about is benefits. And this is neat because you kind of see a reflection of what's going on in the market in the actual M&A market, and the appetite for benefits books has been bifurcated. Buyers do not want small account benefits, but buyers want large account benefits more than ever. We asked a panel of leaders of industry acquirers in May of 2013 what their interest was in large account benefits, and as you can see on the slide, they're more enthusiastic than ever, by and large, to buy large account benefits books.
Mm-hmm.
And so the demand for this business is pretty strong, and that is meeting an increased supply of large account benefits business from folks that are realizing that they need to join up with a partner that's got resources to keep them competitive. The world of benefits brokerage is becoming way more resource intensive as clients continue to demand value-added services like communication or wellness or actuarial help, and a lot of benefits firms that are, call it, $3 to $5 to $6 million in revenue, are finding that it's tough to provide those resources in a cost-effective manner, and to try to do that and perpetuate or do that and grow is getting difficult. And so a lot of those firms have said, gosh, we need to align with somebody that can really bring some resources and help us stay competitive with our large accounts. And so there's this kind of land grab opportunity going on where a lot of these firms are for sale and looking to really bolster their resources by joining with a partner, and that's creating a lot of M&A activity.
Mm-hmm. Fascinating.
So it's really interesting stuff, at least to kind of M&A nerds like me and the rest of the guys at Reagan. The M&A market is strong. We think it'll be strong, and one of the questions we always get after kind of talking through this is, where do we go from here? And so we will kind of outline what we think about 2014 in terms of activity and value, noting that, of course, these are just projections based on what we know now, and we are apt to be wrong. We think that there'll be more deals announced in 2014 than there were in 2013. We'll kind of get back to more of a normal market in terms of number of deals. Not sure that there'll be as many large deals announced over $100 million, and also won't have that kind of weird pull forward tax law change effect that we had in 2012 and 2013. So we think deal activity remains strong in 2014, and we think valuations also remain strong. We don't right now see any reason why valuations would decline from where they are in 2013, but valuations are just so high that we truthfully don't see a ton of room for them to move up. There are things that could affect this. As we talked earlier, any kind of spike in interest rates could affect private equity demand and pricing. Any correction in the stock market that pushes broker EBITDA multiples and valuations lower could affect their demand and pricing. So this isn't, this is a constantly evolving equation, that the supply and demand and the valuations for agencies. But based on what we know now, where we've got low rates, where we've got high valuations, where we've got strong broker performance, and we've got a lot of competitive, acquisitive, aggressive buyers, think valuations are likely to remain strong in 2014, and that the overall health of the M&A market should be pretty solid.
Well, that's very good news, and I'm glad I've learned more here in the last 30 minutes than I ever thought I would about this subject, and I'm really glad that you have done this research. It really helps us all. So let me thank you and Bobby Reagan and all for doing this for the industry. I think you're doing a great thing for us. But in the meantime, if people want to talk to you, how can they get hold of you? Because
sure.
I know they do. There you go.
Well, here's our contact information. You can our website and phone number are here. And George, I appreciate you having us on. This is something that we enjoy talking about, and it's something that we do a lot of. We are very active in the M&A market, helping clients either find a strategic partner to sell or buy. And we're also very active in internal perpetuation and helping agencies remain privately held. So it's something we do a lot of, and really appreciate the chance to come on.
Well, it's my pleasure, and I appreciate it. And for those of you who read Monday Morning and listen to it, don't forget to go back to the email that came, because you can find the archive there, roughnotes.com or AgenciesOnline.com. And we hope you'll do that, and hope you'll join us again Monday morning. And once again, to Reagan and to Brian Deitz, thanks for everything.